its future
In this video,
expected
we're going to
cash flows are
discuss
expected
a little
to go
bit
down
more
by
about
85
bond
million
prices.
a year.
In this
for the
case,
next
we're going to
10
start
years,
talking about
right?
interest
They have
rate
50
and
million
interest
shares
rate risk,
outstanding, no
and
debt.
how they have an
Cost of
impact
equity
on
is
value.
8%. If this
So
news
let's
came
first
as a
talk about
complete
time.
surprise to
How does time
investors,
affect
what
bond
do you
prices?
think would happen to the stock price?
A bond is a loan.
You can think
It's a
if
different
bad
kind of a
news
loan, though.
happens,
It's a loan that has a
what would that
par
do to
value
your
of $1,000.
appreciation?
But it
of the
is
stock?
not an amortized
Obviously,
loan like a
it
car loan.
would decline.
So the
But
$1,000
we can
is ultimately
quantify
payable
this, right?
on the maturity
We know what
date.
the value of the company
At the end of the time frame.
$85
So all
million
bonds on
is
their
what the
maturity date
decrease is
are
going to
equal
be.
to or have
Cost
a
of capital
value
is
equal
8%.
to
So
their par value.
$570
In
million
this case, it would be $1,000.
is the
So as you
decrease
see
in
here, we
value
have
of the
these
company.
zero coupon
If
bonds,
you plug this
different
into the
coupons
stock
here.
price, right, the
They all
valuation
obviously
model,
start off with values at time
$570
zero.
divided by the
But
50,
as we get closer and
right,
closer
with
to the
$50,
30-year
50 came from
maturity,
50 million
they
shares,
all
the stock
eventually
price would
become
roughly
equal
fall
to
around
$1,000.
$11.40.
So again, the
Because
yield to
this news
maturity,
is public,
again,
and
if
its
everything
effect
else in
on
the
the
world is
firm,
staying the same,
free
the yield
cash
to
flow is
maturity
crystal
doesn't
clear,
change,
we would
right?
expect
But
the
as over
stock price
time,
to
what we'll
drop
find is the
nearly
value
instantly. It's
ultimately
going to fall very
has to
quickly.
be equal to $1,000.
What
There's
about
an inverse
private
relationship
information,
between
or information
interest rates
that's
and bond
difficult
prices.
to interpret?
As interest rates
Private
and bond
information is
yields
held by just a
rise,
few people,
bond
right? That's why
prices
it's
fall.
private.
and
Right?
vice versa.
They may be
So the
able to profit by
sensitivity
trading on their
of a
information.
bond's price
If
to
they can do
changes
that,
in
in this
interest
case,
rates
obviously the
is
effective,
measured by
efficient
something called
markets
duration.
hypothesis
And
won't
duration is
hold
a
in the strict
statistical
sense,
measure,
right?
again, of
As
sensitivity.
these informed
What
traders begin
change
to
in
trade,
price
though,
occurs
they're
when
gonna
a change
tend to
in
move
interest
prices,
rate occurs.
so that over time,
Bonds with
prices
high
will
durations
begin to reflect
are very
that
sensitive
information
interest
as
rate
well.
changes, and of
So
course,
with
vice
profit
versa.
opportunities
So
from
we
having
want to talk a
private
little bit
information are
about what
large,
happens
right?
as
There's
interest
lots
rates
of
change.
opportunities.
What is
Other
this impact?
people are going
How
to
does it
devote a lot
affect
of resources
value?
to
We already
try
know how
to
it
get
affects
this
value.
information.
But what is the overall
But the
influence?
information is very difficult
So
to
interest
get,
rate risk
right? In the long run,
is the
we
risk
should expect that
associated
the degree of
primarily with fixed
inefficiency in
income
the market
securities.
is
Certainly
limited
bonds fit
by
into
the
that
cost of
mix.
obtaining this
So
information.
price risk
Since the
is
information
the
is hard
change
to
in
get,
price
it's going to
that's
be
due to
hard for
changes in
people to
interest
get
rates.
it.
This is
and
the thing
trade
we've been
on it,
talking about
right?
throughout some other videos.
So
That when interest
if you
rates
think about
change,
some
value
private
changes.
information,
So
right? Here's a
long-term
company, right?
bonds
If
are going to have
they just
more
announced a
price
new
risk
drug,
than
seeking
short-term
approval,
bonds.
if they
That
get
is,
approval, future profits,
theoretically speaking,
right,
they should
are
have
gonna
higher
increase
duration
by
than
750
short-term
million,
bonds.
or
Obviously,
$15
then
per
low
share, given its
coupon
50 million
bonds
shares.
are going to
If
have
the development
more
of this
price
drug
risk.
was a surprise,
So long-term
and if the
bonds
average
and
likelihood of
low
the FDA
coupon
approval is
bonds
10%,
are going to be
what would you
more
expect to happen?
sensitive to
Well,
risk,
Yeah,
to interest rate
10%
changes
approvals,
than
10% competition should
the
lead to an
alternative.
immediate jump
So
in the
price
stock
risk,
price. 10%
when
of the
interest
$15
rates go up,
is
prices go
$1.50,
down.
right?
And of course, you
No matter
recognize
what,
that is
what's
a
gonna
negative
happen over
influence.
time?
That's not a good
Analysts and
thing when you
experts are gonna
lose
look
value.
at this much closer
Reinvestment
now. The
rate
information is now
is the
public.
uncertainty that comes
So
as interest rates
possible
change in the
paths
future.
of this price
So
has changed.
interest rates rise in the
Kind of
future
dependent on what happens as
when
the
you
future
receive the
gets here.
coupons from bonds.
Right? So we
You're
end
going
up
to
at what?
reinvest
There's this
those,
announcement,
and of
the
course you'll
stock price
reinvest them at
rises
a
dramatically.
higher
But
interest
what's
rate
gonna
than what you
happen
could have
after that?
previously. So
As
when interest rates are
analysts
rising
gather
in the
this
future,
information, if
that
they're
is a
gathering it and they
positive
have
thing if
positive
you own bonds.
feelings about it, we
Short-term
can see a
bonds
continuing
are going to have
increase
more
in the stock price.
reinvestment risk
However,
than long-term bonds.
if it turns out
And
that
high coupon bonds are
there's
going to
a
have more
decrease in the
reinvestment risk
probability
than
that
low
the
coupon
FDA
bonds.
is going to approve this, right? If
Yeah,
there
let's
seems
think
to be
about
like
these
there
two
could be
things.
some negative
Whenever
influences
interest rates
on free
change,
cash
both
flow,
of these
in
things
the end, we
happen.
could see the stock price
One's
ultimately
positive,
decrease
one's negative.
after this initial jump.
So the influence, which
So again,
one
what does
is
this mean
greater,
for
if
investors,
you will,
right? If
is
stocks are
dependent on
fairly
the
priced,
types of bonds you
then
have.
investors
Now, when
who
we
buy
think about
stocks
individual
can expect to
bonds,
receive future cash
this
flows
concept
that
doesn't
fairly
really
compensate
flow
them for the
together
risk. right? In this case, right, the average
real well.
investor
We will
can
talk
invest
about duration
with confidence,
a little bit later
even
on.
if
But
he is
essentially,
not fully
we just
informed.
need to understand that
But what does
when
it
you're
mean for
managing a
corporate
bond
managers?
portfolio, you want to make
Number
sure
one, they
that
need
you
to
can,
focus
to the best
on
of
net
your
present
ability,
value and free cash
control
flow.
interest
They need
rate
to
risk.
avoid any of the accounting
So we have
illusions that are
two
available
identical
to them,
bonds.
right?
The difference,
Investors see through
one's a short
accounting
maturity,
changes.
one's long maturity.
And they need
Again,
to
from
use
here, you can see
financial
that the
transactions
slope
that
of the
support
curve
the
reflects
investments
that
of the
long-term
company.
bonds
We'll talk
are going to
about
be
this a
much
lot
more
further
sensitive.
when we
They
get to
change
talk about
more when
finance.
interest
How do you
rates change
finance
than
the
short-term
operations
bonds.
of the company?
And likewise with coupons.
So
you
the
see that
efficient markets
low
hypothesis
coupon
states
bond
securities
is
with
going to be
equivalent
more
risk
sensitive,
should have the
going
same
to be more
expected
volatile than
return.
the high coupon
An
bond.
arbitrage
So,
opportunity is a situation.
Mathematically, we
Again,
can
we've talked about this
identify
before,
that
where we have
these
securities
changes.
with
But
identical
how do we
cash
want to use
flows
that, or how do
and
we
risk,
use this?
but they have
Well, there's a
different
concept of
prices.
something called
If the
immunization.
market is efficient,
So what
we
happens
should
to
not be
assets
able
when
to
interest
find
rates change? We know that their
arbitrage
value
opportunities.
falls. So if their
That's the
assets
end
are
of
negatively
this
related,
chapter on stock valuation.
but they have differing, what if assets are negatively rated
Let's
but
look at
have
some
different
problems for chapter 6.
durations? That means they're going to
The
move
first problem
at
is
differing
really
rates.
very
They have
simple, just
different
trying to
levels
identify
of
yield
sensitivity.
to maturity from
So
prices.
let's say you require
So
a
what we have
specific
here is
amount in the
some
future,
4 different
and you
bonds.
don't want to overinvest.
And here are some
Right?
dollar
So let's,
prices of these bonds, and they are
Make this example.
$100
So
face
let's say you
value
need $1 million
bonds.
in 10
Now,
years.
how this works in
One of
reality,
the ways you can guarantee
most bonds
you
are
get
not
$1 million
$100 face.
in
Most
10
of the time,
years
they're $1,000
is to buy
face
1,000
value.
zero coupon
And usually the
government
prices
bonds.
are not
That would
stated
guarantee
in
you
dollars,
$1 million
but stated in percentages.
10 years.
So in this case, the
However,
percentages would
that's
be
a
the
maximum
same.
investment.
They just
Maybe
wouldn't have
you
the
don't
dollar
need
sign,
to
they'd have a
spend all that
percent
money.
sign.
What's the opportunity
So
cost?
this 1-year bond in
of
reality
missing other
is, let's say,
investment opportunities because our money's all tied up
98.04%
in this
of
particular
1,000.
strategy.
So if it's 98.04%
We could buy
of
some
100,
corporate
that's
bonds.
$98.04.
But again, if interest rates
But
change over time,
in reality, if it's
we
a
know that the
$1,000 bond,
reinvestment
this would
risk
be
is going to change.
$980.40 for
So how are we
for
going to be certain
$1,000
that we'll
face
get $1
bond.
million
You move the
at the end
decimal
of this
place
time?
1 point.
Immunization is the process. And we're not going to get into great details about immunization.
So as we look, we
But
just need to
immunization
input
is
the
the
data
process
into some form of a
creating a
spreadsheet or a
bond
formula.
portfolio
We have
so that the
the
duration of the bond portfolio
bond valuation
equals the
worksheet
investment
where you
horizon.
input the par value.
So in this case,
it's $100.
we want
and the price
a
$98.04.
bond
So
portfolio
1 year to
that has
maturity.
a
And
10-year
it solves over here
duration. If we can
for the
maintain
yield
that
to maturity
10-year
here, which is
duration
2.0%.
for the next 10
So if you
years.
buy this
Of course,
bond
every year
at
it changes,
98.04,
right? So every year
you
goes
would
away.
earn 2%
So if we can
this year
maintain this
as the yield on
immunization,
that investment.
we would be guaranteed
The other bond that the
within,
other bonds
you know,
were
a few
multiple
dollars
year bonds.
to have that $1 million
So if you paid
when we get to
$95.18
final,
for a 2-year
need
bond,
for the money.
we would have to change the data. You'd put
So
the
let's
price
kind of
here,
move on and talk a little bit more about this
$95.18,
concept
but you'd
of
have to change
duration.
the time to maturity
Disney
to 2.
sold $1 billion
If you
of
did that,
50-year
that
bonds.
answer would be
They had a 3.5%
2.5%
coupon,
is the average
and they sold
yield
with
to
a yield to maturity
per
of
year
4.2%.
over the life of this
If this bond
investment.
is selling for $850,
So again, you can solve for that and
What
plug in the
is
data
its
as you
duration?
will to make sure that your answers
Again, if we
coincide
plug our
with
numbers
the
in,
answers.
we find
down
out here's
below.
the price is $850. We find
The
out that the
second kind
yield
of
to
problem
maturity
looks
is around
at what's referred to as a
4.23%.
corporate bond.
If we
In
go
this case, we're going to look
to
at a
this bond valuation
semi-annual
worksheet,
bond.
go to the
Now,
lower
really,
right,
the difference
you'll
between
find
these
that
semi-annual and
the
annual
modified
bonds
duration is
all has to do with
21.55.
compounding
So
frequency.
if
in this
interest
case,
rates change
bonds
by
typically do
0.1%,
pay bond
right?
interest
0.1%.
semi-annually.
the change
So
in value
normal
will be a negative
instances,
2%.
This should be a 2.
So the new
But you
price
could also
is going to
say
be
it's annual.
$831.68.
The outcomes will be different.
There is a
obviously,
term
but they're all
called convexity.
analyzed
We
the
won't get
same.
into a lot of
So
detail
here we have $1,000
but it's just an
par value,
additional
7 years to maturity,
fine
9%
tuning
is the
will.
coupon rate.
So under
and
fine
the price is
tuning, we would see that again if
$1,080.55.
it changed
So
with
if you
fine
look at the very
tuning,
first
it
question,
would
is what
change
is this
negative
bond's yield to maturity?
2.12%.
Let's look at the data
So we
first.
would
You
be
know
off
it's a
a couple of
9%
pennies,
coupon,
not very much in this
but
case.
since we're paying a compounding frequency of 2,
the idea here
the
is that
coupon
duration
per period
helps us
is actually
measure
4.5%.
the sensitivity.
Now, in the formulas,
it
time
is
to
very
maturity is
similar to
also
thinking
then
about the
adjusted.
sensitivity
So it's
of
the
beta
time to maturity is
to changes in the
is
stock
based on
market.
period. So it's 7 years.
So let's think
2
about some
periods
basic
per year.
concepts
So in the
about
formula it's
bond
used, it's
pricing
actually
theory.
14.
Bonds
is
of
the number
similar
that's used in the
risk
formula.
will be priced to yield about the same rate of return.
So the yield to
regardless of
maturity
their
on this
coupon
bond is 7.5%.
If you know the price of one bond, you
So
can
what's the
estimate its
value
yield
of the
to
bond if
maturity.
it's selling at
And you
that
can
yield
use
to
that
maturity?
to find
So
the
if you
price
put
of a
that yield
second
to
bond.
maturity in for
Again,
the required return,
kind of
right? It's selling
relating
at
to
this
the law
required
of
return,
one
this
price
yield
that
to
we've talked
maturity.
about a couple
The
of
bond
times.
value that's published is
Two things that are essentially
$1,080.55.
identical. In this case, identical from a risk
So you
perspective.
can, when you plug in required
Should have the
return,
exact
you will
same
actually
return
solve
because they have
for
the
the
same
bond value.
risk. And again, we can
What
use
if the
this
company's
with other
risk
concepts.
factors
We can use this
increase the required
valuing
return
other assets.
to
We have 2
8.5%?
assets that are
What's going to
similar
happen to
in risk.
value?
They should
Well,
maybe
if-
have
if
similar
risk
types of
increases,
of
we know the
yields.
required return increases.
Let's
So
take
if
a minute and just
7.5
talk briefly
goes to
about
8.5,
government and corporate
what
bonds, the
happens to
difference.
value?
Right? We know the
You
government
can
issues
plug that
debt.
in if you want to
We
do
know
this
that
problem.
federal,
If you change
state,
7.5 to 8.5,
local governments,
first of all,
right?
you
They
know
all
that the
issue
value
bonds.
is going to decrease.
We need to discuss a little bit
because,
about
when
the impact
risk
of
goes up,
these
return
types
goes
of
up. That means the
investments.
value goes
So
down.
government
The
bonds
new value
have
for this
special
stock for this bond would be
tax
$1,025.
Essentially, the way the rules work,
98
the
So let's
entity
look at another
that
problem.
issues the debt
Apple
is the
has a
entity
bond has
that you
30
pay
years to
taxes
maturity.
to.
It's 3.75%
So let's think about
coupon
Treasury
and a double A
securities.
plus rating.
If you
Current
buy a
quoted
federal
price is
government bond,
93.399.
then you're going
Again, you remember from a previous
Then
slide.
you're going to have
that is
to
a
pay
percentage.
taxes on the interest
Double
the
A
federal
plus
government.
bonds have been earning
So
on
it
average
is then tax exempt
3.98%.
from
Again,
state
assume
and
the bond
local
here
governments.
pays interest
So
annually.
T-bills,
So first
pure
of all, what's the
discount
value of the bond?
Again,
We
you're
need
gonna
to
pay
input all the data
interest,
we have in the yellow
pay
boxes.
taxes to the
And
federal
remember,
government.
compounding frequency is going
T-notes,
to be
1 to 10
because
years.
we're
T-bonds
saying that
obviously
they
greater
pay
than
their
10 years.
interest on an
But the
annual
important
basis.
part here is the taxation.
The value of this
Pay
bond
taxes
should be
to the entity that issues the debt. Municipal
But you could
securities
buy
then are
this
issued
bond
by
for
state and local
$933.
governments.
So this is a
So
good
that means you're
investment.
gonna
We would
pay
pay
taxes
$933
to state and
to
local
get something
governments.
worth $960.
They'll have varying degrees
yield
of
to
default
maturity
risk for sure.
solve
Since
for this
now
is
they are not the federal government.
4.14%.
That means they're not
Which basically
necessarily
means what? If you buy this
risk-free.
bond on average,
But again,
you're going to earn
because the
4.14%
states
over
and
the life
localities are issuing it,
of the
they are
investment.
tax exempt from federal debt. So if you were a wealthy
What is the
investor,
discounter premium? Well, it's
and you wanted to buy
$1,000
bonds,
bond, and the
probably
value
never
is
would,
$960.
but if you wanted to buy bonds,
so the
what
discount
kind of
on
bond
the value is
would you buy a
$39
corporate bond
and it
where you
looks
pay
like,
taxes to everybody?
87
Would you buy a
cents.
federal
Right, the difference between
bond
1,000 and 960.
where you pay
But
federal
if you look
taxes?
at the price, the
or
difference
would you
is
buy
the
municipal
discount is
bonds
a little bit deeper.
where you pay,
right, it's
hopefully I've
$66
given away the
and
answer.
a penny.
You pay the
Will get
lowest
you
taxes.
$1,000. So
Most
when
states
you talk
have
about
relatively
discount premium,
low
you're really talking
tax
about the
rates
difference from
compared to the
$1,000.
maximum
If
personal
interest
tax
rates in the economy
given
decrease
this
by 1%,
quirk
what's
in
going to
the
happen to the
tax
value
law.
of the bond? Well,
How do
when
we
interest
understand, or
rates
how do we
change, the
choose
required
between
return
bond
changes.
investments?
That means it's
Well,
going
we
to go
want to
down
talk
by
about
1%.
something called the
We would expect the
after-tax
value
yield.
of the bond to
A
increase.
taxable bond
So in
has
this
a yield
example,
of
if you
8%,
change the
and a
required
municipal
return
bond
from 3.9
has a yield of
to
6%.
2.98,
So which would you
or
rather have,
3.98 to
8 or
2.98,
6%?
You'll see that the
Well,
value
kind of makes
of the
sense. You
bond
obviously would rather have 8
increases.
than
In this
6.
case, to 11.
But there's a very
51,
there's a
31.
good saying that says it's
then
not how much money you make.
The
that counts, it's how much
valuation
money
and
you
the
keep
exercises
that counts.
with respect to
So
bonds
we need
are
to
actually
understand
fairly
something
simple,
about the
right? There aren't a
taxation.
lot of questions.
So if
There
you're
aren't
in a
lot of
30%
variables that we
tax
have to
bracket,
worry about
what
when we're
return
predicting
would
values
you be able to
and yields.
spend if you buy a
And the
corporate
last
or a
problem here, we have a
government
company
bond?
has a 5% coupon,
So if
20
you're in a
years maturity.
30% tax bracket,
The
you
current
take
price is
the
$890.
debt or the excuse me the
In 6
yield
years, the
on the
deferred call
government
can
bond, the
become
taxable
effective.
bond,
And the
multiplied by
company will
1
pay a
minus
call
T.
premium
That means you would get to
of
keep
$1,050.
you would get to
When we
keep
input the data that
5.6%.
we know.
So and with the
right?
municipal
What is
bond,
the
because you
current
pay
yield?
no
Well, the current
taxes,
yield is 5.
then you'd be able to keep 6%.
This
So
is
which
just
would you
the
rather
coupon,
have?
The interest
5.6 or
payment
6?
divided by the current
Obviously,
price.
you'd rather
so
have
$50
6. So in
divided
this
by
case,
$890
because
is
of this tax
5.62%.
quirk,
That's the
the
actual
municipal
return
bond
you
is a
will earn
better
the first
investment
year
than
if
the government
you own
bond.
this bond.
At which interest
What
rate
is the
would you
yield
be
to
indifferent?
call? Putting the
So if
information
you
in the
solve
cells
for
below,
T that
we're
equates
told
these
that
two
the call
rates,
premium,
you
and I
see
just
that if the tax
realized
rate
there's
was
a mistake here. This says
25%,
1,080.
you would
should
be
be
indifferent.
1,050. Bear with
Anything
me.
more
you put in
than
1,080 here,
25%,
again the wrong number.
and you would rather
6
have the
years
corporate
to go.
bond,
The yield to
anything
call
less than
is
25%,
8.49%.
you would rather
And I
have
apologize
the municipal
for that,
bond.
but we need to also.
So
put
that's just a
this,
little bit
put
about the
make
tax
sure you
quirks
understand that
with
there
respect
is a little
to
mistake here, right? So again,
bonds
the
and
difference here
investing
is
in
the yield
bonds.
to maturity and the
I'll
yield
see you in
to
the next
call
video.
will rarely be the same.